Hey everyone, so I want to share with you some tips on how to avoid ruining your credit score. There are things that will damage your credit score big time, which can cost you tens of thousands of dollars in additional interest should you go to get a mortgage or a personal loan or an automobile loan, whatever it is. Your interest rate will be through the roof if your credit stinks. So the first one is missing a payment. Now, if you're 30 days late on something, most companies, especially major companies, will report that, and that's huge. Matter of fact, missing just one payment, especially on a mortgage, could actually drop your points by 100 points. So you want to make sure that you are making those payments on time. And I always say, if you're facing hardship, pay your mortgage first. Pay your rent first. A lot of landlords are actually reporting rent on credit reports now. So you want to make sure that you pay that on time first and then the rest, okay? Because where you live is more important. Now, your history of payments, by the way, make up about 35% of your credit score. Something to think about. That's why it drops it so much if you miss a payment. Next one is maxing out your cards. When you get closer to that, your limit on your credit card, that will hurt your points. So let's say you get approved for a $5,000 card. Your first thought might be to just go on an expensive vacation, max it all out, right? Which by the way, if you max it out and then you pay it off right away within a month, okay, that's not a bad thing. Okay, a credit card is oftentimes safer to use on vacation, but if you carry that balance month after month, that's going to hurt you. Credit cards, actually maxing out credit cards affect your score by about 30%. My next one here is shopping for new credit. This isn't as bad because it only accounts for about 10% of your score. But when you take a window of opportunity, right? I don't know, a week, 2 weeks, and you are applying for different options. I mean, it's gonna dip a little bit, okay? However, if you're doing it too much, then chances are it's going to affect your score even more. Or if you're applying for something 1 month and then the next month you're doing it again, and then the next month you're doing it a couple times, that will hurt. So avoid opening many lines of credit, right? Which, let me actually elaborate on this too. If you're opening up, let's say 2-3 credit cards, that's gonna dip your credit score at first. Next one is missing medical payments. Many lenders, when you're looking for a mortgage, don't actually account for medical. At least that's how it was when I was in there. Or they do a calculation because medical bills oftentimes came up when something happened, when you had to go to the hospital or you weren't feeling well. Okay, it's not like you just went out to a hospital and just said, "I'm just gonna shop here." Okay, but if you miss even just one payment. Let's say on a $100 bill, your credit score could actually decrease by 100 points. So you want to make sure that you are paying those payments as well. My next one is co-signing for a credit card or loan. Actually, episode 295, I talked about joint loan applications and how that works. So I actually invite you to check out that episode on YouTube. But co-signing for a credit card or a loan, right? Doesn't matter if it's a mortgage or any type of loan. If you co-sign on it, quite honestly, it should be avoided because if the other person misses that payment, you get hit. Your credit score goes down if they make a bad decision. Okay. Another one. This is a strong one. Many times people like to do balance transfers every year to avoid paying a high interest rate. And I totally get that. If you're aggressively paying down stuff, you might have to do that. However, if your credit score goes down because you don't have a lengthy account, which is this one, your length of account matters in your credit scores. The longer you have a card, the better. Even if it's paid off, you just want to make sure that you have cards open for a while or something open for a while. Again, even if you're not using it or if you use it once in a while, so they don't shut it down, that will help your score. Okay, you charge something, pay it off within the month. But you want to think twice about canceling credit cards. And I would say the length of your credit card accounts, right, how long they've been open, accounts for about 15% of your credit scores. So not too high up there, right, 15%, but still not bad. A longer history will result in a higher credit score. That's what I want you to think. I want you to think about that. Okay, even if you, let's say, go from a Capital One card, which is, I don't know, 25, 30%, and you transfer that balance over to something else that is a much lower, keep that card open, unless you have multiple other ones open, but keep that card open so that your credit doesn't tank. So I hope you found these tips valuable. Have you had experience doing any of these? Have you had this happen to you? Don't be shy. Go ahead and share those thoughts in the comments. Otherwise, I appreciate you watching and make it a great week.